So this is my first live stream, the first week, and the idea is that I'm gonna have weekly live streams where I talk about Bitcoin treasuries, all of the smaller ones and the bigger ones, like mostly MSTR, but also every single Bitcoin treasury company, every company that has Bitcoins on the balance sheet. And I'm running Halvix, which is an AI-driven Bitcoin treasuries data aggregation website where I'm tracking all of the Bitcoin treasuries, Bitcoin holdings, and all of their debt instruments, financial data, everything pretty much. Um, so I think it's gonna be very interesting to have weekly live streams where I just gather all of the data that I think is interesting every single week, and then I present it in a live stream format. So that's the plan. And for today, we also have an agenda that I'm gonna try to cover, and we'll see how long the live stream is. So Sequence has sold more bitcoins. We have Parataxis and Prenetics who have abandoned their Bitcoin treasuries strategy. BitMax has escalated its situation and it has issued another convertible bond. And that I'm really gonna talk more about, and that situation is very interesting. Capital B has issued more shares, or is about to issue more shares, and has lowered the conversion price for one of its convertible bonds. So we're gonna talk about that and how it relates to Bitcoin denominated convertibles. And then we have Jack Mahler, who has been on the Bitcoin conference, and he had some ideas about how he's gonna use operating income to really separate himself from the other Bitcoin treasuries. So we're gonna talk about that. Smarter Web continues to accumulate more Bitcoins. And H100 has had an acquisition of 2 Norwegian companies and will go from about 1,000 Bitcoin holdings to 3,500 Bitcoin holdings. And then I'm gonna talk more about generally smaller Bitcoin treasuries and how to think about investing in those companies, how they compare to something like MSTR, and really just a good strategy for smaller Bitcoin treasuries to have going forward. And then, of course, yesterday there was the MSTR earnings call, so I have some ideas about that, and we're gonna go over some of the things I think is interesting, that I agree with, and some of the things not so much, but some of the things maybe I disagree with or think could have been shown a little bit better by MSTR. So it's a lot to go over today, so I'm just gonna get into it. And of course, the first piece of news here is Parataxis, who is abandoning the Bitcoin treasury strategy. And it's almost even worse than it sounds, because they're not just abandoning the Bitcoin treasury strategy, they are renaming themselves from Parataxis Korea to Parataxis Ethereum. So it's a pretty bad situation, and we'll see how it turns out. And then we have Prenetics, who will go from holding 510 bitcoins to really adopting a policy against future digital asset purchases. Not all of these companies can have diamond hands, and a lot of them are getting scared off by this bear market, and it's pretty clear that a lot of these companies simply don't have the conviction necessary to be Bitcoin treasury companies. So I think it's in some sense a good thing to just for these companies to see which companies have conviction, to see which companies can hold on to their Bitcoins and which companies get scared away. And Sequence continues to sell Bitcoins. So at its peak, Sequence had over 3,000 Bitcoins, 3,234 Bitcoins. Today they have 1,114 Bitcoins. And this is mainly because of them wanting to pay back their debt. So if we scroll down here, so we can see their convertible, they have one convertible where the principal was $189 million. And they have just successively been paying off this convertible. And today they only have $35 million outstanding. And they have simply sold Bitcoins to pay back this convertible, and that's why they have so much less Bitcoin today than they had last year. And they actually have a plan to redeem the entire convertible by next month. So we're likely gonna see even more Bitcoin sales by this company until they effectively have no leverage. And this is what we're gonna talk about now, the BitMax situation. I wrote an article about this last month, and it's a very interesting situation. This company is the most leveraged Bitcoin treasury, I would say. They have the worst capital stack out of all Bitcoin treasury companies, and it's a public company, but it's more like a public shell of a private company. All of the actions within this company are mostly insiders trading with each other, and the convertible bonds within this company are basically held by the same entity, and that's what we're gonna talk about now. So BitMax just issued a new convertible to pay off the past convertibles that already passed the put date. And this new convertible has a much lower conversion price, so the dilution will essentially be over 200% when this convertible converts. So we can go over to the current MNAV for BitMax is 0.54, but the fully diluted MNAV after this new convertible converts, it's gonna be closer to 1.5 x MNAV. So even though the MNAV looks low on paper, it's really not that low. And we can look more in depth of this instrument that BitMax issued, and we can just see on the conversion price that it's very similar to the share price, and it's already 26% in the money. So the investors are getting a very good deal with this convertible. It's a 3% coupon and essentially 0% conversion premium. And if you want to know more about the BitMax situation, I highly suggest that you go back to my BitMax article and read about it and really see how all of their prior convertibles, you can see their capital stack here, all of their prior convertibles are held by the same entity. And if that entity and all of these convertibles are past the put date, so that entity could redeem those convertibles and the company would be liquidated. But since all of these people are insiders, that's not gonna happen. So what they're gonna do instead is to just refinance and to create a lot of dilution instead of a liquidation. So this is the article you can go read. You can read the BitMax article I published. Moving over to Capital B, they have a new capital raise by Adam Back, and they're gonna issue $1.1 million of shares or euros of shares. But the more interesting aspect of this news is the lowering of the conversion price of their B series convertible bond. And we can just look at this convertible bond to start off with. And the most notable thing is that it's effectively Bitcoin denominated. So the B series of Capital B's convertible bonds is denominated in Bitcoin. And I have my ideas about Bitcoin denominated convertibles and if they're good or if they're... I don't think they're so good for the company really, because when you're issuing a normal convertible and it's fiat denominated, then the Bitcoin your Bitcoin holdings has a chance to essentially outgrow the fiat debt. But when you're holding Bitcoin, you're just gonna repay the original Bitcoin that you held on your balance sheet. So the only productive path for the company is if the convertible converts. And this can be a good thing. But since the forced conversion price is above the conversion price, at the time it's like selling shares at a discount. But of course the Bitcoin holdings can grow in price at the same rate, and then it can be productive. But I'm just thinking about what Capital B really gains from lowering the conversion price of this convertible, or if it's mostly a deal with Adam Back maybe, so that they can issue more shares. And the bigger question, I guess, is it accretive for Capital B to issue shares? And we can go to the company, and the basic MNAV is 0.9. So it seems that it might not be accretive to issue new shares. But it really is. You should really look at the fully diluted MNAV and not the basic MNAV when determining if selling shares into the market is accretive, because the convertibles will likely convert. So you need to assume that all of these financial instruments will convert in order to make a good decision. So with a 1.3% MNAV, 1.3x MNAV, then it's obviously a good idea to sell shares into the market. And let's go over to 21 Capital and Jack Moller. So he published this video that we're gonna watch, and we can react to it. I thought it was very interesting. I watched it yesterday, and I have some pretty strong opinions about operating income and if Bitcoin Treasury should focus on operating income. I think they should not focus on operating income, and I'm gonna tell you after this video.
I think the ideal Bitcoin company, the dream Bitcoin company, looks like this. So I made this quad graph here, where on one side of the spectrum you have extremely low conviction in Bitcoin, and on the right side of the spectrum you have extremely high conviction in Bitcoin. And on the bottom side of the spectrum you have extremely low operating income as a business, and on the top side of the spectrum you have extremely high operating income as a business. I think on one side of the spectrum you have crypto exchanges. And these exchanges make tons of money. They are economically such good companies. Like you're talking about billions of dollars of net profit. They're growing 10, 20, 30% year over year. So I put them in the top left quadrant because they are high operating income. However, the reason I don't want to build a business like that, I wouldn't want to work for a business like that, I personally wouldn't want to be a customer of a business like that, is they display extremely low or no conviction in Bitcoin. These businesses don't seem to really care about Bitcoin. Like I cited in my talk, Coinbase is holding almost $11 billion in cash and fiat right now versus there's no operating income. They're not producing cash flow. And my dream as a founder and a CEO is to be in the top right quadrant. And that's where I don't think any company is, which is both an incredibly high operating income business, has customers, has cash flow, has products, and it also displays extremely high conviction in Bitcoin. And that's where I'd like to see 21 focus and where I agree with Tether's proposal. So you can almost think of 21 almost like a Bitcoin Berkshire Hathaway in a way. It's not a perfect analogy, but the idea is 21 has a financial services division, and this is our ability to build and distribute Bitcoin financial services for the Bitcoin economy. Another Bitcoin infrastructure, and for me, this is the physical economy of Bitcoin. So this is power contracts, these are miners, these are sites, these are physical infrastructure that both protects and mines and propagates the Bitcoin network. And pillar number 3 is capital markets. And this is a lot of the Bitcoin treasury company strategy that exists and some more. Let's take a look at an ability to raise cheap capital, acquire reasonable leverage with Bitcoin on our balance sheet. I mean, 21 already has 43,514 Bitcoin. We can absolutely use the capital markets to our advantage to display further Bitcoin conviction. But because we would have other products and services.
So essentially what he's saying is that 21 Capital is going to do a mix of the capital strategy that Strategy is doing, and then also have some Bitcoin native infrastructure to support the Bitcoin network. And I just spontaneously, I think it's very similar to what Marathon Digital Holdings is doing. They're a Bitcoin miner, and then they also issue convertibles to buy Bitcoin and follow the Sailor playbook. But I really think it's a little bit dilutive to the Bitcoin treasury, because when you're a miner, it's not really in line or supportive of the capital markets. Like if you're gonna hold mining gear, that's capital that you can instead hold in Bitcoin. You're deciding to hold the mining gear instead of Bitcoin. And the mining, Bitcoin mining, is really not a high conviction play in Bitcoin. It's an arbitrage on the cost of electricity. So you don't really have any Bitcoin exposure as a miner. And that's really where I maybe disagree with where 21 Capital is heading towards. Really the best strategy is a very simple strategy with a high focus on maximizing Bitcoin exposure. And when you have a lot of moving parts, it's not gonna be as high Bitcoin exposure as if you're doing what Sailor is doing by simply issuing preferreds. You're not gonna be able to have as high Bitcoin exposure by holding miner gear as if you're holding Bitcoin and issuing preferreds and buying more Bitcoin. So I think it's a little bit dilutive to shareholders to not 100% focus on the capital strategy. And especially since 21 Capital is the second largest Bitcoin holder, they could easily just go into the market and start issuing preferreds raise as much capital to purchase Bitcoin as possible. And then I just hope that they buy Bitcoin and don't buy mining gear. And the next thing is that Smarter Web Company continues to accumulate Bitcoin. Let me show you here. They don't sell any Bitcoin and they just keep accumulating Bitcoin. And that's because they have a new Coinbase credit facility where they are drawing cash all the time to purchase Bitcoin. So this is quite bullish. It's not as good as the preferreds, obviously, because it's debt and it has an expiration. But leverage is leverage. And the only thing, and a main reason of why I think they issued or is drawing money from the Coinbase facility is because they have a Bitcoin denominated convertible that matures in August. So they're likely going to have to repay 178 Bitcoins. The conversion price is £2. I'm going to check yeah, it's essentially like 400% out of the money, right? So unless Bitcoin does something crazy until the summer, Smarter Web is gonna have to repay this principal. And it's a zero-sum game. They got 178 Bitcoins and now they're paying back 178 Bitcoins. So they're not losing anything and they're not gaining anything. So when you have this like Bitcoin denominated convertibles, the only real gain or loss, however you think about it, for the company is the conversion. And I'm trying to think myself how to think about this. It's very complicated, but the company gets the Bitcoin at issuance, and then when it converts, the Bitcoin has gone up in price. So it's still better for them to have gotten Bitcoins than to sell shares at the conversion because they will be able to buy less Bitcoins. But also when the convertible is forcibly converted, it's always at a discount since the conversion price is at a discount to the forced conversion. So I think it really depends if Bitcoin goes up a lot and the company doesn't go up a lot but still converts, then it's very beneficial to have the Bitcoin denominated convertibles. But if Bitcoin goes up just a little bit or nothing at all, and the company stock goes up a lot enough to forcibly convert, then it would have been better for the company to just issue shares, wait and issue shares. So it's a complicated dynamic. But I think mainly the main reason why companies issue these Bitcoin denominated convertibles is that it has the illusion of Bitcoin accumulation. Or not even, it's not really an illusion because they are accumulating Bitcoin if it converts. But in some sense, they could also just as well sell shares, like have a direct share issue, even at a discount, if they wanted to. But I think I'm not gonna judge the Bitcoin denominated convertibles, and I think they can be pretty good. It just depends a lot on how the stock performs and how Bitcoin performs. And I made this article 3 days ago about Bitcoin Treasury convertible bonds and really how to analyze these convertible bonds, where I go over the principal, conversion premium, all of the important aspects of a convertible bond. So if you're interested in learning about Bitcoin treasuries and really understanding the instruments behind the Bitcoin treasuries like convertible bonds and preferreds, then I suggest you go to my personal website, sebastianfern.com, and you can read the 2 guides I have published as of now, and then I'm also gonna publish a lot more going forward, hopefully. So that's the shout out. And then H100 is also big news. It happened about 2 weeks ago, so it's not news, but it's important enough for me to bring it up in this live stream. The current Bitcoin holdings of H100 is 1,000 Bitcoins, a little bit more than 1,000 Bitcoins. And they have a signed agreement to purchase 2 Norwegian companies, which would bring their Bitcoin holdings to 3,500 Bitcoins. And the idea of this acquisition is that the Bitcoin per share remains the same. So the common stock shareholders doesn't really have any BTC gain from it, but the company has more Bitcoins on the balance sheet, which will give them more opportunities. And the idea that directly comes into my mind is, of course, that they're gonna start issuing preferreds. That's the reason why you want a large balance sheet. You want enough Bitcoins to use as collateral to start issuing preferreds. It's pretty obvious to me that's what they're trying to do. And Sanders also had some additional insights that this acquisition isn't neutral in the sense that Bitcoin per share remains the same, but the company also carries liabilities, and these liabilities will shrink as a percentage of the company when H100 acquires these 2 new companies, which I thought was also pretty interesting. But I'm also a little bit split on my thoughts about this, because on one hand, as an investor, you want to invest in companies that have a smaller Bitcoin amount for the maximum upside. Like if you just want the maximum Bitcoin exposure through, let's say, preferreds, then you could just as well invest in strategy, because they are doing that perfectly, in my opinion, and they are trading at sub 1x mNAV, and they have they're they're so much in front of all the other companies in their development, and what they have managed to do with STRC is quite extraordinary. So if I would invest in any other companies other than MSTR, what I'm really looking for is much smaller Bitcoin holdings, and then really strong conviction and a hyper aggressive strategy to really acquire as much Bitcoin as possible through share issues and convertibles. But this strategy, of course, only works within a bull market. So what I would do is choose a company like H100, who doesn't have too many Bitcoins, who has shown a very strong conviction in Bitcoin, and who are hyper aggressive when it matters. Last summer, what H100 did with tranches really is the ideal strategy, I think, to set up a system to issue as much shares at a high mNAV as possible. That's how you win in a bull market, and it's also extraordinarily good marketing. And then moving over to MSTR's earnings call, which was yesterday, and there were some very important updates like being willing to sell bitcoins and updates about MSTR, and we're gonna talk about all of the other things they mentioned that I think is important or interesting. So the first slide to really capture why MSTR is winning right now is the really high percentage split between credit and MSTR. So we can really see how STRC has been issued more and more, and how common stock MSTR is being issued less and less. And this is a growing trend, and it's not gonna stop anytime soon. STRC is only growing in popularity, so we're only gonna see this diverge even more. And we're seeing preferreds on the upswing again. In the 1800s and early 1900s, all of the projects like building railroads and electrical grids that were very, very long-term projects, they couldn't be financed by using normal debt. It would be very difficult for them to have a, let's say, 5-year debt and then build all of this infrastructure within 5 years. Sometimes it would take even longer. So how they financed it is with preferreds, which is a perpetual dividend essentially. And this has been used quite a lot throughout history by corporations who have very long-term thinking, but also by governments to raise money. And now in 2025, we're seeing strategy take back the idea of preferreds and make it popular again. And Stretch is, of course, the most popular preferred, or maybe the second one after Boeing, but Stretch is the most sophisticated and the best preferred issued within this decade. And STRC has a very high Sharpe ratio. So what a lot of people are talking about today is the carry trade with Stretch. The ability to, normally you talk about how you can borrow money to buy bitcoins, but another carry trade is to simply borrow money and to buy Stretch. And then you can even do it on a much shorter time period just because Stretch has such a low volatility. So if you have a mortgage of, let's say, 6%, then you can just take out a mortgage, buy STRC, and capture a risk-free 5% spread. So I think this is one of the main reasons so much capital is flowing into STRC, because a lot of mainly retail investors right now, actually they showed it on this earnings call that 80% of Stretch investors are retail investors. And I think a lot of them are seeing the opportunity to use Stretch as a carry trade, and that's why MSTR has been able to raise so many billions of dollars off STRC. But I also think that STRC is going to become very popular within corporations, and as Saylor talked about on the earnings call, it's very easy for companies to buy Stretch. When they buy Bitcoin, it's very, very difficult. But when they buy Stretch, it's much easier because of the regulations. So we're gonna see Stretch adoption grow more and more, and especially as companies realize the value of STRC as well. And another just slide that caught my attention is that MSTR uses an MNAV definition of enterprise value divided by Bitcoin holdings. And I'm actually not sure why they use enterprise value. I think it's quite a bad metric in some sense. What I think really captures MSTR much better is the one they're proposing here secondary, is the ADSO market cap, which is the assumes a fully diluted shares outstanding. Because this tells you much better when it's accretive to issue shares into the market to increase Bitcoin per share. And what you want to do, you don't just want to increase Bitcoin per share right now, but you want to increase Bitcoin per share after all of the convertibles have converted. And that's why the ADSO MNAV is so powerful in my opinion. And there are so many different ways to decide whether it's accretive or not to issue shares. And it really depends on how you model the Bitcoin price as well. Because if you model the Bitcoin price to not increase in the future, then you might take all of the debt and all of the preferreds into the equation as well, and just model how much Bitcoin does the common stock shareholder actually own after all of the obligations are paid off. But these obligations will either grow or shrink depending on how the Bitcoin price evolves. So I think it's quite a complicated subject, but as a Bitcoin treasury, you mostly assume the Bitcoin price to go up quite a lot. So it makes sense to assume that all of the convertibles will convert and that all of the fiat, like the preferreds and all of the fiat debt, will simply go to zero against the price of Bitcoin. I think that's the overall best metric to decide whether it's accretive to issue shares. And MSTR has some new principles that they follow. The most notable one is to sell Bitcoin when it's advantageous to the company. And I think this is an improvement, because there are definitely situations when it's accretive for the company to sell Bitcoins. If the MNAV is below 1, then it's more accretive for the company to sell Bitcoins to pay off the dividends or whatever than to issue shares. So it's a good optionality for the company, I think. And this slide simply shows how the Bitcoin yield changes when you sell Bitcoin to buy MSTR, which I think would be a very interesting trade for strategy to consider. And as you can see that below 1x MNAV, it's accretive to sell Bitcoin to buy MSTR. And the entire goal is to increase Bitcoin per share for the common stock shareholders. So I think this trade would make a lot of sense. And when you're selling Bitcoin to buy MSTR at 1x MNAV, then there is no change to the Bitcoin yield or the Bitcoin gain. But what it's showing to the right is how the Bitcoin rating and MSTR risk changes. But I think what they should also show is how the amplification changes. When the Bitcoin rating decreases and when the risk increases, It also means that the amplification increases, so the common stock shareholders actually get more Bitcoin exposure than if they would not have sold the Bitcoin to buy MSTR stock. So it's almost like you're issuing more STRC when you're selling Bitcoin to buy MSTR per share. It's like how much STRC issuance per share, how much amplification per share. And this amplification increases when you sell Bitcoin to buy MSTR. So I think it could be an interesting idea to even sell Bitcoin to buy MSTR at a 1x MNAV just to increase amplification. And going forward for MSTR, I think this graph really just captures where this company is heading. MSTR is trying to pay off all of the convertibles, all of their debt, and go fully into the preferreds. And there is a massive divergence since they started issuing preferreds last year, where amplification grows and leverage decreases. And this is a growing trend that's not gonna stop anytime soon. We're gonna see this diverge even more than it's currently diverging. And it will be interesting to see the amplification that MSTR eventually reaches, how much amplification they want, because it's a bit of a trade-off. You don't want to have too much Bitcoin risk, but you also want as much Bitcoin exposure as possible. But the MSTR is nowhere near too high Bitcoin risk as of now. It has 50 years of dividend payments being able to be paid out. So I think they could increase their amplification even more than it currently is. But that's all for today, and thank you for watching, and see you next week.